Today we are covering most important 21 record to report interview questions and answers. We are covering them in a mock interview format so you get the flavor of actual interview. So let's not waste any more time and get started with it. Thank you for coming in today. I'm excited to discuss your experience with record to report processes. Let's start with the basics. What is record to report process in simple words?
Thank you for having me. So, record to report, or R2R as we commonly call it, is essentially the entire accounting cycle that starts from recording business transactions and ends with generating financial reports. Think of it as the journey of financial data, from the moment a transaction happens, like a sale or purchase, all the way to when it appears in our financial statements that management and stakeholders use to make decisions. It's basically how we capture, process, and report all the financial activities of a company.
That's a good overview. Now, what are the main sub-processes under R2R?
Right? So R2R has several key sub-processes. The main ones include, first, we have data collection and journal entry posting. Then there's account reconciliations, which is huge in R2R. We also have the period end closing activities, financial reporting preparation, and compliance reporting, and intercompany eliminations if you're dealing with multiple entities. Each of these has its own set of activities. For example, in my previous role, account reconciliations alone would take us about 3 to 4 days every month because we had to reconcile bank accounts, fixed assets, payables, receivables, pretty much every balance sheet account.
What are the types of journal entries you have passed in your experience?
I've worked with quite a variety actually. The most common ones are standard journal entries for regular business transactions. Then there are adjusting entries. These are really important at month end for things like accrued expenses, prepaid adjustments, or depreciation. I've also posted correcting entries when we found errors in previous postings. Reversal entries are another type I use frequently, especially for accruals that need to be reversed in the following period. And then there are reclassification entries to move amounts between accounts when something was posted to the wrong account initially. In my last company, I remember posting a lot of intercompany entries to eliminate transactions between our subsidiaries.
Let's talk about accrual accounting. What is accrual accounting and why is it important in R2R?
Accrual accounting is the method where we record transactions when they occur, not when cash changes hands. So, if we provide a service in December but get paid in January, we still record the revenue in December. This is really important in R2R because it gives us a more accurate picture of the company's financial performance for a specific period. Without accruals, our financial statements would be, well, pretty misleading. Like, imagine if we only recorded revenue when we received cash. Our December numbers might look terrible, even if we had a great month in terms of actual business activity. In R2R, we rely heavily on accruals to ensure our reports reflect the true economic reality of the business.
Good explanation. Now, what's the difference between accrual and provision?
That's a good question, and honestly, people sometimes use these terms interchangeably, but there is a difference. An accrual is typically for expenses or revenues that we know have occurred and we can measure pretty accurately, like accrued salaries. We know exactly how much we owe employees for work done. A provision, on the other hand, is more for uncertain amounts or timing. Like we might create a provision for potential legal costs if we're involved in a lawsuit, but we're not sure exactly how much it'll cost or when. So provisions involve more estimation and uncertainty compared to accruals. Both appear on the balance sheet as liabilities, but provisions usually require more judgment in determining the amount.
That makes sense. Can you explain the month-end closing process in R2R?
Sure, month end closing is always intense. It typically starts a few days before month end, with us preparing cutoff procedures to ensure transactions are recorded in the right period. Then, once the month ends, we post all our accrual entries. Things like accrued expenses, prepaid adjustments, depreciation. After that comes the reconciliation phase, which is probably the most time consuming part. We reconcile all major accounts, bank accounts, fixed assets, payables, receivables. Any differences need to be investigated and resolved. Then we prepare trial balance, review it for any unusual balances, and make correcting entries if needed. Finally, we generate the financial statements and supporting schedules. In my experience, a typical month-end close takes about 5 to 7 working days, though we have been trying to shorten it.
How do you ensure accuracy while passing journal entries?
That's crucial in R2R. I have a few practices I always follow. First, I make sure I understand the business transaction before posting anything. I review all supporting documentation, invoices, contracts, approvals. I also use a standard format for journal entry descriptions, so they are clear and consistent. Before posting, I always check that my debits equal credits. Sounds basic, but you'd be surprised how often people miss this. I also review the account codes to make sure I'm posting to the right accounts. And whenever possible, I have someone else review my entries, especially for significant amounts. We also maintain a journal entry log to track all postings, which helps with audit trails. In my last role, we had a policy that any entry over $10,000 needed supervisor approval before posting.
What are intercompany transactions and how are they handled in R2R?
Intercompany transactions are transactions between different entities within the same corporate group. For example, if company A sells goods to company B and both are subsidiaries of the same parent company. In R2R, these need special handling because when we prepare consolidated financial statements, we need to eliminate these transactions to avoid double counting. So we track all intercompany transactions separately, usually using specific account codes. During consolidation, we create elimination entries to remove both the intercompany revenue and the corresponding intercompany expense. The tricky part is ensuring both entities record their side of the transaction consistently. I remember in my previous role, we had monthly intercompany reconciliations to make sure both sides matched before we could proceed with elimination entries.
Let's discuss fixed assets. What are fixed assets and how are they accounted for in R2R?
Fixed assets are long-term tangible assets that a company uses in its operations to generate revenue. Things like buildings, machinery, computers, vehicles. In R2R, we account for them at their cost when acquired, and then we depreciate them over their useful life. So every month, we post depreciation entries to reduce the asset value and recognize the expense. We maintain detailed fixed asset registers that track each asset's cost, accumulated depreciation, and net book value. We also handle additions, disposals, and impairments. For example, if we buy a new computer for $2,000 with a 4-year useful life, we depreciate $500 per year or about $42 per month. During month end, posting depreciation entries is always part of our closing checklist. We also perform periodic physical verification to ensure our records match what's actually there.
What's the difference between balance sheet and P&L account?
The balance sheet shows the company's financial position at a specific point in time, like a snapshot. It has assets, liabilities, and equity. And it always balances because assets equals liabilities plus equity. The P&L or income statement shows the company's performance over a period of time, like a movie. It shows revenues, expenses, and the resulting profit or loss. In R2R, we're constantly working with both. For instance, when we record a sale, it increases revenue on the P&L and increases accounts receivable on the balance sheet. The key difference is timing. Balance sheet is as of a date. P&L is for a period. And at year end, the P&L gets reset to zero, but balance sheet accounts carry forward to the next year.
What are adjusting entries and why are they needed?
Adjusting entries are journal entries we make at the end of an accounting period to ensure our financial statements are accurate under accrual accounting. They are needed because not all transactions are recorded during the period, or some need to be allocated across periods. The main types are accrued expenses like utilities we've used but haven't been billed for yet, accrued revenues for services we've provided but haven't invoiced, prepaid adjustments like insurance we paid for but covers future periods, and depreciation expenses. Without these adjusting entries, our financial statements would be incomplete or incorrect. For example, if we don't accrue December's electricity bill, our December expenses would be understated and our liabilities would be understated too.
How do you perform GL to Subledger reconciliation?
GL to Subledger Reconciliation is basically making sure the detailed records in our subledgers match the summary amounts in our general ledger. For example, our accounts receivable subledger shows individual customer balances, and this total should match our AR control account in the GL. I start by extracting the subledger detail and the GL balance as of the same date. Then I compare the totals. If they don't match, I investigate the differences. Common reasons include timing differences. Maybe a transaction was posted to the GL but not yet updated in the subledger or vice versa. Sometimes there are posting errors or reclassifications that weren't properly reflected. I document all differences and their explanations. We typically do this monthly for major accounts like AR, AP, and inventory. It's time consuming but essential for ensuring data integrity.
What are some common errors in R2R and how do you avoid them?
Oh, there are quite a few common ones I've seen. Posting to wrong accounts is probably the most frequent, like posting an expense to an asset account or vice versa. Cutoff errors are also common where transactions get recorded in the wrong period. Mathematical errors in calculations, especially for complex accruals. And duplicate entries. Sometimes people post the same transaction twice by mistake. To avoid these, I always double check account codes before posting. Use standardized journal entry templates when possible and maintain proper documentation. We also have review procedures where someone else looks at significant entries. For cutoff, we have specific procedures around month-end to ensure transactions are recorded in the right period. And we run regular reports to identify unusual balances or duplicates.
Have you worked with any ERP systems like SAP, Oracle, or Blackline in R2R?
Yes, I've worked primarily with SAP in my last two roles. It's quite comprehensive for R2R processes. We used it for journal entry posting, account reconciliations, and generating financial reports. I'm familiar with transaction codes like FB50 for journal entries and FS10N for GL account balances. I've also worked with Blackline for account reconciliations. It's really helpful for standardizing the reconciliation process and maintaining supporting documentation. I found Blackline particularly useful because it automates a lot of the matching process and provides good audit trails. Oracle I have limited exposure to, but I've heard it's similar in functionality. Each system has its learning curve, but once you understand the R2R process, adapting to different systems becomes easier because the underlying concepts remain the same.
What is trial balance and how do you check if it's correct?
Trial balance is a list of all general ledger accounts with their debit and credit balances at a specific point in time. It's called a trial balance because we're testing whether our books are in balance. Total debits should equal total credits. To check if it's correct, first I verify that it actually balances mathematically. Then I review each account balance to see if it makes sense. For instance, cash should normally have a debit balance and accounts payable should have a credit balance. If I see unusual balances like a credit balance in an expense account, I investigate further. I also compare current balances to prior periods to identify any significant unusual fluctuations. Sometimes I run age trial balances to see if there are old items that need attention. The trial balance is really the foundation for our financial statements. So any errors here will flow through to our reports.
What are reclassification entries? When and why are they used?
Reclassification entries are journal entries used to move amounts from one account to another without affecting the total assets, liabilities, or equity. We use them when transactions were posted to incorrect accounts, but the total amount is right. For example, if someone posted office supplies expense to office equipment by mistake, we'd create a reclassification entry to move it to the correct account. We also use them for presentation purposes, like reclassifying long-term debt to current portion when it's due within a year. I've used them frequently during month-end when we discover misclassifications during our review process. Another common situation is reclassifying between different expense categories for better financial statement presentation. The key thing is that reclassification entries don't change the overall financial position, just how it's categorized or presented.
What are recurring journal entries? Give some examples.
Recurring journal entries are entries that we post regularly, usually monthly, for the same amounts and same accounts. These are really helpful for standardizing routine postings and reducing errors. Common examples include monthly depreciation entries. The amounts stay the same each month for most assets. Rent expense is another one if you have a fixed monthly rent. Insurance amortization for prepaid policies, loan interest if you have fixed rate loans, and amortization of intangible assets. In SAP, we could set these up as recurring entry templates, which saved a lot of time during month end. Instead of creating the same journal entry from scratch each month, we just had to run the recurring entry program. It also reduces the chance of errors since the account codes and amounts are predefined. We typically review these quarterly to make sure the amounts are still accurate.
What is the purpose of performing balance sheet account reconciliations?
Balance sheet reconciliations are crucial for ensuring the accuracy and completeness of our financial records. The main purpose is to verify that our recorded balances actually represent real assets, liabilities, or equity. For example, when we reconcile our bank account, we're making sure our cash balance is accurate and that all transactions are properly recorded. For accounts receivable, we're confirming that the amounts we show as receivable are actually collectible. These reconciliations help us identify errors, missing transactions, or items that need follow up. They also provide supporting documentation for auditors. In my experience, unreconciled items often lead to bigger problems later, so it's better to address them promptly. We typically reconcile major balance sheet accounts monthly, and the reconciliations need to be reviewed and approved by supervisors to ensure quality.
How do you handle suspense accounts or open items?
Suspense accounts and open items require careful attention because they can indicate underlying issues. For suspense accounts, these are temporary holding accounts where we post transactions when we are not sure of the correct account initially. The key is to clear these regularly. We shouldn't let items sit in suspense for too long. I make it a priority to investigate and resolve suspense items during each month end. For open items like unmatched invoices or unresolved differences in reconciliations, I maintain detailed registers to track them. Each item needs to be researched. Sometimes it's just a timing difference. Other times it might be an error that needs correction. I communicate with relevant departments to get clarification on unclear items. The goal is to minimize these over time by improving our processes. In my last role, we had a policy that any suspense item over 30 days old needed management approval to remain open.
What's the difference between standard journal entry and reversal entry?
A standard journal entry is a regular entry we post to record business transactions. It stays in the books permanently unless specifically corrected. A reversal entry, on the other hand, is specifically designed to reverse a previous entry, usually in the following period. The most common use for reversal entries is with accrual entries. For example, if I post an accrual for utilities expense in December, I'd set it up as a reversing entry, so it automatically reverses in January when the actual bill comes in. This prevents double counting the expense. The reversal entry has the exact opposite debits and credits as the original entry. In SAP, we could flag entries for automatic reversal, which was really convenient. Standard entries require manual intervention to reverse them if needed, while reversal entries are designed with that specific purpose from the beginning.
What steps do you follow during the year-end closing process?
Year-end closing is definitely the most intensive period in R2R. It starts with all the regular month-end procedures, but with much more scrutiny. First, we ensure all transactions for the year are properly recorded and cut-off procedures are strictly followed. Then comes the extensive reconciliation process. Every single balance sheet account needs to be reconciled and any differences resolved. We also perform detailed analytical reviews, comparing current year to prior year for unusual fluctuations. Year-end adjusting entries are more comprehensive. Things like inventory adjustments, bad debt provisions, bonus accruals. We also handle depreciation calculations for any mid-year additions. Tax provisions and related accruals are prepared. Then there's the audit preparation, organizing all supporting documentation, preparing schedules, and responding to auditor requests. We also start thinking about disclosures for annual reports. The whole process typically takes 3 to 4 weeks in my experience, with lots of coordination between different teams. It's exhausting but also satisfying when everything ties out perfectly.
Excellent. Your experience and understanding of R2R concepts is quite comprehensive. Do you have any questions for us about the role?
Thank you. Yes, I'd love to know more about your current month-end closing timeline and whether you're looking to implement any process improvements or new systems. Also, what's the team structure like for R2R functions here?
Great questions. We'll be happy to discuss those details in our next conversation. Thank you again for your time today.
Thank you so much for the opportunity. I look forward to hearing from you soon.
So that's the wrap. Hope you got some value from this video. If you did, subscribe and give this video a like. See you in next one.